Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Now, here's an example of looking at these two charts, or here are charts of these particular indexes with the trades that I did. And one of the things I like to do, because I'm kind of a visual person, I like to work with numbers, but I also like to look at charts and be visual. So what I've done on this example is the very first trade I did was the 140 calendar on the Australian dollar, and there are my calculations for my long-term numbers. Long-term break even 145.50, unlimited after January, and my max loss is 550. The red line down there that has 145.50 on it shows where I need to be in order to break even in the long term. And you can see that as of the January 9th or whatever the date was I put this on, that if I'm moderately bullish, as I am in my first example here, you can see that the index is going to have to rise up in order to be above that red line by the long-term expiration in order for me to make money. Whereas in my second example, where I was actually a little bit bearish in the near term, you can see that the index can actually drop down to the green line, and it only has to be above the green line in the long term in order for me to hit my break-even price. So I kind of want to draw these lines sometimes on the chart so that I can visualize where it might look. That helps me to look at a longer term chart of the index and see if it makes sense that it could actually be in these zones that I want it to be in at expiration. If I draw a line and it happens to be in a place where when I'm looking at a 6-month chart, that index has never been there, then it might be a little optimistic to think it's going to get into that zone. I want my lines to appear in places where I've seen that this index has been there before, and so it's very possible that it could actually get there again. Second example here. This is the yen trade. You can see that the long-term trend on the dollar versus the yen has been down, down, down for a long time. And you can see why I chose, based on this particular chart, to be longer-term bearish on the dollar versus the yen because it had been losing ground for about 5 months. And as I mentioned, what it actually did right after this trade took off was it dropped sharply all the way down to 90.69 by the January expiration, which was pretty close to where it was at its low there in mid-December. But I put the two trades on, the slightly bearish trade where I'm expecting it to get to 95 by expiration, and the extremely bearish trade where I'm expecting it to get all the way down to below 90, or in this case 88, by the long-term expiration. Now, the red trade, in my opinion, is a slightly bearish trade. It's a little more conservative. Is it realistic to think that that index is going to be in that zone by the time March? I would say it is, because it was in that zone virtually the entire month of December. My other trade's a lot more aggressive because I'm expecting that it's going to get down below my long-term break-even there, which is 88. And the truth is, based on this chart, which covers almost 6 months of data, it only spent 1 day below that level in that entire period of time. So it's a little aggressive, I guess is probably the better way of putting it, to think that it's actually going to be below that green line in the end. But you may want to do it anyway because ultimately it could turn out that you'll make more money if it does happen. So so I guess the summary would be what I said earlier. Target, use puts or calls depending upon whether your long-term opinion is bullish or bearish. Then use the strike price based on where you think it's going to be at on the first expiration. As I mentioned earlier, that's probably the simplest way to sort of tie this all down. If you want to put a visual out there, you can do it once you calculate where those break-evens and those types of things are at. So let me go ahead and just summarize, and I think I'm right on the mark here. The advantage of a calendar spread over a straight long option is a couple of things. First one is you don't need any movement at all to be profitable. If you start out with your strike price being roughly at the same price as the index is at the moment you put your trade on, you can be nicely profitable if the index stays absolutely flat, because that's the ideal point for it to be, is actually right at the strike price at the near-term expiration. With a long option, if the stock's at the same place that your strike price is at the moment you buy your option, you're not going to make money because the time value is going to erode. You can't make a profit. So this is one of those trades that gives you the ability to make money in a sideways market, whereas a long option, whether it's a long put or call, that's not possible. You always have to cover the cost of that spread or the cost of that option in order to make money. So it has to move either up or down. Overall, the cost of a calendar is a lot cheaper than a long option because you bring in that money on the short leg. That helps pay for a portion of the cost of the long leg. And because that cost is lower, then you've got less money at risk. You've got a closer break-even price, and you've got overall, you just got less capital outlay, lower break-even, and a whole lot less risk. What are the disadvantages of a calendar versus long option? Well, the profit potential is limited. If your index moves sharply in the direction you think it will, once your short-term option expires, you can make a lot of money. But if it moves into the right spot in the short term, you can make a small amount of money. Whereas a long option has the ability to have an unlimited upside and a pretty sharp, pretty potentially large profit on the downside. Based on what broker you trade at Schwab, we have multiple option approval levels. Some will allow you to trade long options, some allow you to do spreads, some allow you to do naked options. If you're not a real experienced options trader, your broker may not give you the approval to trade a spread. You may end up only being able to trade long options. Personally, I think spreads are a lot less risky and they make more sense, but they're also a little bit more difficult to understand. So you may run into issues with your broker if you don't have a lot of experience trading options. And some brokers, again, they impose a certain amount of net worth that you have to have in your account in order to trade certain types of strategies, so that if things don't go well, they've got some collateral to cover losses that you might incur. You're going to have a higher margin requirement, potentially. In most cases, you probably won't, but it's possible. And you're going to have a little higher commissions. That's probably the only real downside that I see to a calendar, is that because you got to buy one leg and sell one leg as opposed to just buying one leg, you're typically going to have a slightly higher commission cost. Questions? I think this is time to go ahead and run into some questions. How much time we got, Steve? We got a half an hour here, 15 minutes?
Yeah, let's do another 10 minutes or so. Paulie's got one, Randy.
Perfect.
He says he trades a lot of calendars, and he knows that there's a long Vega risk with calendars. How would you hedge your Vega risk in IC options? And actually, a bigger question is, whether you're trading the ICFX options or any option, do you worry about that Vega risk when you're looking at the calendar spread?
I do worry about it a little bit, but what's nice about spreads of any kind is that Vega risk is not a real big factor. Because when you trade any type of spread, you've got one long leg and one short leg. Whatever Vega risk you're taking on one leg is being wiped out, not entirely, but a good chunk of it gets wiped out on the other side because the two offset each other. That said, it's very possible that you'll have different Vegas on the two legs. As you mentioned, Steve, earlier, and as I illustrated in my example, when I put these spreads on, the Vegas, the volatilities were higher than they are right now. What I typically try to do when I'm doing a spread is I'm looking for a spread. I'm going to take the considerations into account that I mentioned earlier. First of all, choosing calls or puts, whether I'm overall bullish or bearish, and then picking my strike prices where I think the stock's going to be or the index is going to be in the near term. But I also want to look at the Vegas, and ideally, I want to make sure that I keep those Vegas fairly close to each other so that they neutralize as much of that as possible. When you go way out of the money or way in the money, you see that the volatilities go way up. And the amount that they go up is going to vary depending upon how far you have until expiration. So the easiest thing I can say is that when you look at your option chains and your broker, whoever that might be, at Schwab, when you look at an option chain, we've got streaming Greek, so you can see what the Vegas are. Compare the two Vegas and make sure that they're fairly well neutralized. That's probably the best thing you can do, is just to make sure that they're pretty close. If there's a huge difference in one versus the other, that may tell you something. It may tell you that something's going on. It may tell you that there's a sentiment out there that there's going to be a big swing, something like that. But what I like about spreads in general is the fact that Vega's not a big issue typically.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.